I'm Mike Sibley, partner and leader of the manufacturing team here at James Moore and Company. I'm joined by my partner and also member of the manufacturing team, Kevin Golden. Today, we are talking about a challenge that would make most companies really happy, uh, but aren't necessarily always prepared for. And we're talking about rapid growth. And rapid growth can be defined in any number of ways for a company. It could be 20% in 1 year, it might be 10% or 30% in 1 year, depends. But there's a lot of challenges that can come about because of rapid growth. It exposes weaknesses, it can really strain systems, and oftentimes management or ownership is experiencing it, but not sure what to do with it, or even
Right.
what the telltale signs of that are. The other piece with rapid growth is it doesn't necessarily mean it's rapid growth in 1 year. It could be rapid growth over a period of years, or it might be just sustainable growth that's been happening so long and you've been busy, but not necessarily looking at infrastructure and pains and things like that. So today we're going to discuss the scaling pains we see and share some examples of how manufacturers stabilize during that period. We're actually going to do this in a 2-part series because
Right.
there's so much. I think Kevin and I could talk all day long on, all the issues that we see, but we're going to try and cut this into 2 parts. So, the first part here, we're going to get going on sort of the operational strain, the cash and inventory and systems, and then we'll get into the next time around, we'll talk more about job costing and hiring and protecting margins and things of that nature. So, Kevin, welcome as always. Looking
Yeah.
forward to a good conversation here.
Yeah. And I think when we talk about this, sometimes you hear, I think of a country song, there's no such thing as like too much money, too much fun, too much those things kind of in jest, right? But when we think about growth, there can be too much growth. And a lot of times it's not that we don't want that growth, right? But it's are we ready for it? What got us to where we are today is not necessarily where it's going to get us to tomorrow, working on the same systems we're doing. So you see yourself very, very busy a lot, but yet you're not prepared to handle that type of growth that you may have, whether it's expected or not. So I think, yeah, while in jest, and we may say, yeah, there's too much growth can be a bad thing. I think too much growth without any other changes, right? And without preparedness, without infrastructure and so forth is really what we're talking about. That can make you feel, disorganized, running all over the place, but not really getting anything done. And as we like stressing on this show, more importantly, building value. You should always be building value in your company. So being busy and growth, that's great. But we want to make sure, are you actually building value with your company more so than you were previously? So,
I think, when we start talking about, you know, systems and processes and companies growing, a company that's a $5 million company, let's just say, actually is very different from a company that has become a $10 million company and 15 and 20. And I kind of say every $5 million, it seems like, there's these changes, these institutional changes that need to happen, or how you're operating. But, what ends up happening is a company that's done really well, when you have a lesser amount of throughput, let's just say, it's easier to get your head around that. It's easier to see it. It's easier to touch it. It's easier to maybe manually move things through it. You just have more control. But as those transactions start increasing, it's harder to have your finger on the pulse of everything. The transactions are increasing more. There's faster. Customers want, better lead times. They want things sooner. So everything starts really, really going faster, but our systems are often still back what they were when they were smaller. And so, let's talk about, some signs that growth is outpacing your infrastructure. Well, when we start talking about it, we see things like cash flow is getting tighter despite revenue growth. Our working capital is really getting tight in there. And we'll talk a little bit more about that in a minute. But when we see that cash, and oftentimes, everyone says, oh, your sales are growing, you must be flushing cash. Not necessarily. It doesn't necessarily work that way because of the working capital timing and those pressures. I know another area, we might have more quality issues, production errors, missed deadlines in getting to the customer's deadlines. We might have inaccuracies, stockouts. So, I hear this a lot with growing companies where they can't produce whatever it is because they're waiting on parts or raw materials or something critical. And so you get to a point and now you have to stop, or you have a whole line that's down because you don't have those parts. And so now you've got downtime, you've got costs, excess overhead costs, inefficiencies, utilization issues, and you're not able to leverage. And so what happens is you start taking these hits to your margin. And Kevin and I have talked about over the, course of time, and I really like the term profit leaks. Well, that starts leading to profit leaks. Mm-hmm. And the problem is you may not even see it unless you're really in tune to your margins and changes in margins. And then, another area, and these are just examples, and we could go on all day, but, if as an owner or your leadership team, management team, you're just firefighting all day long, mm-hmm. as opposed to strategy planning, really working on the business and improving things, you're going to find yourself falling behind because you're not having the opportunity to work on proactive corrections.
Right. Yeah. And a statement I've heard people say, especially on this kind of growth trajectory, is, hey, I know it says I know it looks good on paper, but I didn't make any money. Well, they don't really mean I didn't make a profit, that I really sold my items at a loss or anything like that. What they mean is I have no cash to show for it, right? That's what you feel. When that bank account's low, you feel that, right? Whether it's personal, business, otherwise. So some of these items you just feel in your business each and every day. There's just not a lot of clarity around that, right? Maybe that's maybe because you knew you were growing, you had a lot of CapEx expenditures, right? People that you're going to need, right? Well, do you have clarity into when those should be hired? At what point should they be hired? Or do you have clarity into what's the real price point of growth, right? What are all those increased costs, or you call them profit leaks, that you may have cash leaking out the door, and makes you feel like, hey, I didn't really make anything. Yes, you do. Your cash is just tied up elsewhere, right? Or is your pricing up to date, right? Are you keeping up to, golly, we saw that a lot during COVID and everything, where things just took an unnatural spike, right? So when things like that occur, right, if we're not ready to adjust accordingly, well, there goes yet another profit leak. We're working on yesterday's numbers, but today's sales, right? So again, I think a lot of these things, another takeaway here is not just a profit leak, it's also a stressor, right? Think about it. The good old days of whenever I used to operate underneath, let's go to your example, $5 million, and we were doing really well. Yeah, let's ramp that up to 10. And now you just feel really stressed out. In addition to all, cash flow tightening and all these other things, right? You've got to remember it's as much as a stress on you personally as it is on your financials, as it is on your cash, as it is on your people. And trust me, if it's stressing you, it's probably also stressing the people that are working for you, right? To a degree, stressing them as well. So again, growth, not a bad thing. It's just unchecked growth that you just start doing. You find yourself just doing more, but not really keeping up with, well, what does it take to do that, right? Then again, you're stressed out, cash is tight, and feel all these other pains that you're just, keep you up at night and stress you out. And maybe work isn't as fun as it used to be, right? So,
right. So when we start talking about, okay, well, all right, Mike, so what? How is this happening? What do we do? So, let's start with working capital. Mm-hmm. Let's start there, because working capital is, literally your cash, your AR, your inventory. It's what you can convert to cash, right? And less what your payables are to your vendors. Let's just keep it kind of easy at that level. Well, think about what happens with production increasing. So when production increases, you have rapid growth, you have to buy inventory. You might have 30, 45, 60-day terms with those vendors, something like that, somewhere in that range. So you have to buy inventory. You have to pay people to make the products. You have to pay supervisors to supervise the process. You have to, you have overhead, you have rent, maybe you have, utilities, all these costs. All that is tying up. You're paying for all of this stuff.
Right.
And maybe it takes you a couple of weeks to make to make a product or a series of products for a customer. Okay, so now you got all that cash tied up. You ship it out to the customer. Maybe the customer has somewhere between 30 and 60-day terms.
Right.
So you could be paying cash and being out of cash for anywhere from 45 to 90 days before you finally get paid from that customer. And so that working and those things, the more you grow, the more that working capital gets tied up, and that it really affects your cash. So one of the biggest missing things often in companies, and this is companies from, you know, 0 to $100 million often, is they miss a true working capital management process. And it doesn't need to be the most sophisticated, kind of process. I think it can get overblown, but having that management process around working capital, 13-week cash flows as an example, a process around AR collections. Can't tell you how many clients that we work with where they don't have an actual accounts receivable follow-up process. The cash comes in whenever it is, and customers have 30-day terms. They get trained that 60 days is okay because you don't follow up with them. Right. So there's not a really good AR system in place. And so really instituting a working capital system, management system, can get you going the right direction to get control, because what it does is it highlights the areas of concern.
Right. And you hear too from owners and key employees, hey, I'm too busy. I can't focus on things. I mean, it's actually quite the contrary. You can work yourself out of business, right? You can work yourself into a hole that now you have to make drastic changes, drastic things. So instead, it's think of that time as more of an investment, right? You can't afford not to, right? Because again, as you're growing, a lot of times those revenues and all those numbers, again, look good on paper. They're growing, kind of mask those underlying issues. And it's just like a slow drip, right? You don't have a flood. You're not flooding your house because you got a few droplets of water. It's over time. And as those water become more often and bigger, next thing you know, you've got a big water issue on your hand, as opposed to cutting it off whenever it was just a small drip, right? So I would encourage, if you're an owner, if you're a business and you're a manufacturer and you're saying, hey, I'm just too busy to have that. Hey, that's the time to step back and look, okay, well, what structure do I have? What people do I have? Why don't I have that to reevaluate? Because you've got to be spending some time on these things, or hiring the right people around you to help you spend time, using the right tools to help you spend time on these things. There's one thing to be a manufacturer, and there's another one thing to run the company, right? And you can work yourself into quite a hole. So I think my takeaway there is you could argue that you literally can't afford to ignore these type of items and waiting for it to become a huge issue, because then sometimes it's just simply too late.
Right. And well, and I like, you mentioned, pricing, and, I think that's a really important concept. And I've seen this time and time again when we go in and we start looking at profit margins, and, an easy way to look at things is your material cost as a percentage of sales, right? What's happening there? And you start seeing that, get higher, meaning your raw material costs are, and so oftentimes pricing is not being kept up with, what's happening in your cost system. Think about this: raw materials go up, wages go up, utility costs go up, all these costs go up. But if your pricing is remaining flat, right, what you're doing is you're minimizing that margin. Well, that margin eventually turns into cash. So if your costs are creeping up, your working capital is getting used up. You're producing less cash. Now you're in a really bad cycle because you haven't had this time to really step back and evaluate. And again, it's about having the systems in place to make sure that you can evaluate this stuff over time, the KPIs, the dashboards, the easy ways to look at something really quickly and know I've got a problem.
Right.
We start talking about throughput. Suppliers are sending, they're sending in their price changes. They're sending you, and your accounting team is just processing. They're getting those paid. They're getting those vendors paid. And it's hard often to pay attention to the different inputs that you need to think about with a pricing standpoint, which can have a big cash flow impact. your revenue might still be going up, but your margins are going down.
Right.
And it's hard to understand. It's hard to explain why sometimes without getting into those details, but it can be done, but that'll create even more strain. So rapid growth is great. Rapid growth with declining margins can be really bad.
Yeah.
If not.
Well, and we've done this with manufacturers. One, if you're thinking, well, how do I, again, don't overcomplicate it until it needs to be. Think to yourself, almost every manufacturer I know, when I talked with them and said, hey, how much are you making on X, Y, or Z product, right? That you sell, that you manufacture, they know, right? Or they have a number, they have an answer for me. They put it that way. They have an answer, right? Great. So one sign that maybe you have a problem or something that needs to be addressed in there, whether it's pricing or other profit leaks, as you called them earlier, is, okay, well, what's your profit margin on these products? You then go and actually look at what your profit margin has been on those, and you'll see a lot of times they're not going to be the same, and sometimes not even close, right? Let you know, hey, we probably have a problem here. It could be in pricing. It could be in other rising costs you're just not aware of that are creeping into your margins and eroding those. Okay, well, what can we do about that? Well, the first thing is knowing that you have that problem. So as simple as asking yourself, if you're an owner, well, how much am I making on this product? Okay, well, I think it's, this percentage. Great. Go and actually look at your financials. What does that say that you're actually making on those? You'd be surprised at how that simple question will start you down a path of, well, that's not what I expected. Well, why isn't it? And then you go back and forth with your team looking at, oh, well, what about this cost? Well, I didn't realize that was in there. And next thing you know, it's a lot further off than maybe what you expected. And again, it doesn't usually happen overnight. COVID may be an example of where it can, but usually not. It's slowly over time, all these moving variables that then maybe gives you an outcome that you weren't expecting, right? Especially in times of rapid growth.
Well, I think that's a really good point. Let's step back and stop for just a second. We've talked about working capital, cash, revenue. Those are all key things and some really key things to look at as you grow. What you just said though is things happen over time. And I may have alluded to this earlier too. Oftentimes you won't see that your margin goes from 50 to 40% overnight.
Right.
It usually, it doesn't happen a lot like that. It can. And I've seen it, bad things happen. But what happens is it goes from 50 to 49.8 to 46 and it slowly happens over time, almost imperceptibly goes down because, it's hard to maybe see, or it doesn't look like it's that big of a number, or because your revenue is going up, your dollars are going up, but maybe not the percentages. So you're not paying attention to the percentages. And so I think that's one of the things that is very, very, you got to be very careful on is, again, growth in revenue doesn't equal growth in every other category.
Right.
Could mean growth in costs and loss of growth. So I think we got to keep that in mind, that it's putting in the systems to make sure we don't, death by 1,000 needles or whatever it is, whatever that saying is that's out there. So I think that's one of the things that systems help and standard work helps in putting those things in place. Now let's kind of transition into talking about inventory, the inventory streams. We talked about cash. We've alluded to inventory. Let's talk about, the inventory issues that, they may face. And Kevin, I don't know, maybe you want to knock out a few that you kind of see.
That was perfect. That's exactly where I was going next, is definitely. So on the inventory, a lot of, again, in this rapid growth, what got you to where you were is not necessarily where it's going to take you in the future. Right. And so some signs of that you may, I'm having an inventory breakdown here. Okay. Lack of visibility. So where is my inventory, or what crosses that, what's coming in, what's going out, where is it in between, things like that, right? Because then that leads to, I don't know what I need in the future. What kind of inventory am I going to need? So do I have my supply chain aligned with that, right? Then you may experience that you have excess stock, right? Or worse, you've probably got orders that now you have to rush through the system, which just naturally on itself is going to lead to errors, reworks, things like that cost money, right? Maybe you've got manual processes that go back to your example at $5 million. what you could do manually. You can't do that. You don't have the time or the capacity to do that at a $10 million. Okay, great. Maybe we're working on an outdated manual system that needs to be automated somehow, right? Needs to be tweaked. And so I think those are some just examples of, hey, how inventory in a hurry can, because you can tie up a lot of, going back to our cash, you can tie up a lot of cash in your inventory, right? But how that can also put an operational strain on you and lead to a lot of stress in this time of rapid growth.
Well, I might make the most obvious statement ever said on any podcast out there. Cash is really your most valuable resource, right, in a business. And so, what we're talking about here is establishing systems and ways to secure and save and protect that cash. Now, we're not saying you don't use cash. Cash is necessary to grow, but it's how you do it. It's how you use it. But let's protect our most valuable resource. That's going to keep us in business. If we don't generate cash, we don't stay in business. That's the bottom. You can borrow cash for a while. At some point, that borrowing is going to catch up with you, and you're going to run out of cash, and you're going to run out of ability to maintain that. So let's all be focused here on, yes, we want to generate profits. Of course we do. We're generating profits so we can generate cash. We want to turn our receivables into cash. We want to turn our inventory into cash. Mm-hmm. We want to buy CapEx that will make the products that will build cash. So everything we're talking about here is preserving cash and building cash for the future. So, when we start talking about inventory as an example, and you mentioned poor forecasting or poor ability to kind of have that line of sight.
Yep.
Forecasting is very, very difficult. And, but there are ways to do it with, either getting forecasts from customers or being more proactive with customers, or sometimes that's not easy because it may be more based on just purchasing habits of individual people out there that buy, some of your products. Then maybe more statistical analysis can be used and things like that to help plan out the use. But think about this: if you buy inventory and you buy too much,
right?
And hey, I got a 5% discount by buying a year's worth of this inventory. Great, you're into your line of credit and you're paying 10% interest right now. You're probably going to spend more. And oh, by the way, if that inventory goes obsolete, now you're throwing it out. So that 5% discount or 10% discount that you got,
right,
it's a moot point anyway. You literally took your cash, threw it in a barrel and threw it away. So what we're really talking about here is now moving from an inventory a cash management, working capital management to inventory management. Mm-hmm. It doesn't have to be super, super complicated. I've done this with basic systems. I know some people are, I got to have this advanced MRP system, too small for that. Not necessarily. Good quality data going in and a good system, and we can do a lot with, some very basic systems out there. So, I think it's got to be a little bit less about maybe in the early term, depends on your size, because sophistication, complexity can change that thought process. But there are ways to put some simple nuances in place to help predict and put some safety in not overbuying inventory or putting it around inventory systems and things of that nature. So I think it's really important to kind of step back and say, okay, how do we preserve cash? How do we track? How do we make sure we're buying the inventory we need, not buying too much inventory, or on the other hand, not running out of inventory?
Right.
So putting some thought process around that.
Bill. And one thing I'll say here too is, especially when it comes to purchasing, you hear, well, why do we buy this amount or why do we do that? Well, that's just what we always do. We always buy it at that 5% bulk discount or whatever. Get away from that's what we've always done. Challenge the status quo, whether it's on process, whether it's on purchasing habits, whatever it may be. Just kind of challenge that, right? And even if you don't have a problem today, hey, we're fine. We're cash flux. We're doing fine. Start stressing that. Okay, well, hey, we have an aggressive growth goal of 10% a year for the next 3 years. Okay, what if we actually achieve that, guys? What does that mean to our systems? How can we handle that with how we're currently purchasing, with how we're currently spending cash, with what our current demand looks? I mean, what does that mean to our people, to us? and everything, put it through a little bit of a stress test, right? That gets into better forecasting, right? And then you'll really see real quickly, oh shoot, man, we can't do that because we don't have the people, or we don't have we'll run out of cash. We won't have that. Putting a little bit of a stress on your systems, even if they're working well, will help you see where the shortcomings are going to be, or the pitfalls are going to be in the future, to go ahead and start making those, again, maybe not even drastic changes today, small changes today, that when you get to that point, it's not such a big hurdle to or big undertaking to overcome, right? So again, staying ahead of that curve of that growth, by taking a look at your ERP, at how you're tracking, again, all these process procedures that you have in place. And does it make sense? Or are we just working off of, well, that's what we've always done?
Right. I think, I think you're right. You do have to work on the business and look ahead and prepare to have the growth as well. But, if you're in this period of rapid growth, you kind of like, well, I can't think about 3 years from now. I got to think about now. Great. But as we're doing it, let's put some basic systems in place, some basic things, and that can be built upon.
Yeah.
And, it's going back to inventory for a minute. And I just, sort of stressing this point. And we're working with a client, we're, analyzing their inventory. And, I said, okay, you've got about 3 months of this on hand. How long does it take you to get this in the door from a supplier? 2 weeks. Okay. So you could literally go 2 months and then make an order and get your product in, still be okay based on the amount you had. Yeah, probably. Well, just so happens that day, a purchase order comes through to that CEO for that part number, which would have ordered another 50 grand of it or something like that. And they already had 3 months of that on hand.
Right.
And they did not even need to be ordering that. He shut that purchase order. And it was somehow just errors in their system, falling back on old ways, whatever it was. And there just wasn't a good control over that ordering process to make sure that they had what they needed. And so, it was creating visibility around orders, needs, and things like that. And on top of that, you get into things like supply chain management. And we're helping a lot of clients now with understanding supply chain needs and management, and how to help manage their cash flows better and their production levels. But oftentimes I hear, oh, well, I got, MOQs, minimum order quantities. I've got, if I buy X amount, I get this huge discount, all these different things. Well, okay. We got to try and work with our suppliers if we can. Sometimes it's hard because they might be larger than you are, and you don't have that leverage. But how do we work with them to try to deal with minimum order quantities and pricing and things of that nature? So that's another whole section of, hey, how do we build those relationships with those suppliers to help with that? Now, discounts, we got to do the calculation. Is it worth it? Is it going to take you 3 years to use that? If you get this big order and you get this big discount, is it going to take you a long time? And you got to remember carrying costs. Holding that inventory can cost you anywhere from 20 to 30% of carrying costs. That's just kind of an average that's out there. And if you're borrowing a lot of credit, that can also. So we have to really look at these various components and say what makes sense, because all of this hurts your profit. All of it puts strains on the business, hurts your cash, and your ability to potentially deliver timely to your customers. So, that's why these systems, and again, when I talk about systems, I'm not talking about ERP systems, or they play a role in it, but there are ways to create systems, even if you're on the most basic setup.
Right. Yeah. No, I agree. And so again, where does this lead us back to? I'm a manufacturer, I'm in rapid growth. What can I do to say, yeah, I know around inventory management, maybe I got a problem, or maybe I'm just in that part where I need to make some tweaks, right? Where, hey, we're growing it all, and what we've done in the past isn't what we need to be doing in the future. Again, do you know where your inventory is? Go back to your example. Do you know how much you have, right? Do you know how long that's going to last you, right? Are you finding yourself having to make a lot of the exceptions that previously you didn't, right? Do you know, not in your mind only, but are you able to see in your systems of how much we're actually making on those, and how does that compare to what we used to do, right? And again, all these are just signs that are basic questions you can ask yourself, look at, or in a lot of times you feel it, that then lead down these paths of, oh, okay, well, maybe that process needs to change. Okay, maybe we need to reevaluate our relationship with our vendor or how much we purchase there, or our purchasing, simply tweaking our purchasing policy, right? I mean, things like that. Again, I agree that, Mike, it doesn't have to be, oh my gosh, now we have to recreate the wheel. But at the same time, if you don't make these tweaks over time, even during expansion or rapid growth, that can lead to long-term payoffs, then at some point you are going to have to recreate the wheel by force, or even worse, you're just going to lose a bunch of money. So you've got to make, you don't want to get to that point where you're having to recreate everything. Instead, evaluating all along and making those tweaks as you go along will then lead you to more long-term success.
Yeah, absolutely. Great way to kind of summarize that up and summarize this session up. And, just, as we come to an end here, like we said, you're going to start seeing these pains early on. It's going to show up in your cash flow, inventory issues, maybe eventually systems and reporting. And, you'll start feeling that strain, and you'll even start maybe even feeling your leadership team or yourself going from planning to firefighting a lot. So as you start experiencing that, if you start experiencing that, try to take that time and start putting some of these things in place to protect yourself. And that's why people like, James Moore and Company, me and Kevin and others in our organization are there to help do that. But you got to take those steps. So, if as you're growing, you may start feeling those, and those are kind of the next steps in order to start improving your own practice. Now, as we shift into, we'll be, I mentioned it's going to be a 2-part series. So part 1, we just kind of went through. Part 2, we're going to continue down the same thought process.
Right.
We're going to get deeper into job costing, margin compression, hiring, maintaining margins and things of that nature. So, KPI. So we'll hit on a deeper level of this in our next session. Kevin, any final words you want to say on this?
I think the only thing is rapid growth can feel like chaos. And it's a good problem to have, right? That's what we want to do. We want to be more profitable. We want to have people want our products and want to use us, but it can feel chaotic. The whole point of this is to really bring that chaotic feel to more clarity. You're still busy. You still got lots to do, but at least some clarity that then brings confidence, not only to you, but to your vendors, to maybe your stakeholders, as well as to any other third party, both now or in the future, maybe looking at you, of saying, hey, they're building it the right way. They're building that value. There's a lot of clarity here because of what they put in place. This makes sense. That's where your ultimate value, both currently and in the future, is going to come from, is taking that chaos, making it more clear, especially in rapid growth.
Yeah, great point. Chaos to clarity. That's awesome. Thanks, Kevin. Thanks for all the input today as well. Thank all of you for joining us. I hope you were able to catch a nugget or two out of this conversation. Again, be sure to also look for the next part on this as well. So again, thanks for joining us. And as always, if you have questions, thoughts, please feel free to reach out to us.
To learn more about James Moore and Company's manufacturing services, go to jmco.com. And don't forget to subscribe to our More on Manufacturing series to receive updates when new videos and podcasts are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us on our website. You can also follow us on social media for more news as the landscape on manufacturing continues to rapidly evolve.